Are you doing self-directed investment? And if you are, what do your returns look like? Are you losing money? Are you making money? If you're making money, are you making more than 10% each year? That's something you should be asking constantly and considering constantly. Now, why is that 10% number so important? Well, it's important because of this, the S&P 500 index. You might have heard of the S&P 500 index before. It's essentially a large index, which means it has multiple assets rolled into it. In this case, it's 505 large cap American companies. Oftentimes, you might hear people talking about how the S&P is reflective of the American stock market or economy. That's because the S&P has several important criteria in order to join their ranks. And because of that, it tends to reflect the large portion of the U.S. stock market. And by and large, if people are buying into the market, the S&P 500 will reflect that. The S&P 500 is managed by these people, the S&P Dow Jones Indices. They're part of S&P Global. And they actually have tons and tons of paper describing their methodology, how they came up with the index, and what it's used for. This is something I went through in a decent amount of detail when I talked about whether or not Tesla had a chance of getting into the S&P 500. I'll have a link in the description if you're interested in that video. So the S&P 500 is massive. It is huge. It is fairly reflective of the overall health of the American stock market, and it has been incredibly stable. If we look at a 10-year chart, we can see over time it's grown, which makes sense. If you're looking at these large cap companies, assuming America doesn't go through extreme decline or collapse in GDP, collapse politically, other things like that, then it simply makes sense that the market will go up over time. We can look at year-to-date returns, 1 year, 3 year, 5 year, 10 year. And we can keep going and going and going. In fact, the S&P 500 is fairly old. The S&P 500 started its early life as the composite index and only involved around 90 stocks. However, it started in 1926. And if we take a look at the historical data for the S&P 500, we see on average it has a 10% annual return, meaning over a long enough period of time, you will on average get 10% more money every single year. And this can compound if you're buying things like SPY, which tracks the S&P 500, but it can be purchased and traded like a stock rather than just an index. You can see they pay dividends. So not only is your account growing in value, but you're also getting dividends. And over time, you can reinvest those dividends into SPY. Now, granted, inflation does exist, so it's not necessarily a perfect 10%, and there are times when the market goes down. The 2008 housing crisis comes into question, and of course, a huge COVID dip was also a big concern. But you have to realize, even if you bought money right at the peak of the 2008 recession, if you just waited a few years, you'd be back to where you were, and you actually would have made money, a lot of money. So a lot of it is about time. There's a common saying, time in the market beats timing the market. And that's absolutely true for newer or inexperienced investors. I'm not trying to say that you can't beat the market. It is absolutely possible. Tons of traders do it all the time. But you do need to consider what your goals are. What are your goals for approaching the market? I think a good format for goals are SMART goals, where the S stands for specific, M for measurable, A for achievable, R for relevant, and T for time-bound. It's a perfect reflection of the market because all of those things do apply. If you're just dabbling in the market because you're curious and you want to try out different things, that's fine, especially if it's a small amount of money. But if you're dumping large amounts of money into the market, you do need to ask, what sort of goals do you have? You have to be specific. What do you want to accomplish? Do you want to grow by 10% every year consistently? Well, then it probably makes sense just to dump your money into the S&P 500. And what sort of actions are you going to take? How are you going to measure that goal? That's fairly easy because you can see how much you get returned in your brokerage account. And a lot of brokerage accounts like Webull actually have tons of detailed charts and other performance information that'll show you how you compare to the market, how you compare to the S&P 500, and whether or not it would have made more sense just to toss all your money into something like SPY and let it ride out. Achievable is an important one. Is your goal doable? Again, there are tons of people that beat the market, and there are huge companies like Berkshire Hathaway which have leaders that consistently beat the market, and that's why they're a massive, massive corporation. If you want to 10x your money in a year, I need you to take a step back and look and see how realistic that is. Are people, on average, 10xing their money in the market? There might be a few rare exceptions, but generally you have to open yourself up to extremely risky option plays if you want to manage something like that. In reality, that's not a terribly feasible goal unless you are privileged to information other people might not have. Relevant. How does your goal align with broader goals? Are you trying to make money because you want to move up an income bracket in the US? Are you trying to make money because you think it's fun? Are you trying to just learn about the market? How does it align with your life? Are you spending all your time drinking coffee and staring at your stocks? Is it making your hair fall out from stress? And then time bound. No one lives forever. That's the reality of the situation. So time is always a factor. And the S&P 500 is used heavily in retirement accounts. Your 401ks and simple plans tend to have heavy investments into large indexes like the S&P 500. And you need to realize if you were about to retire in 2008 and then the market crashed, well, that would not be a fun time to retire. You might not have enough money to retire. Although ideally, as you get farther and farther closer to your retirement date, your account should convert most of its assets into more stable assets like bonds rather than stocks and ETFs. But that is something to consider. If you're a young person, you can afford to hold for years and make back your money, maybe even sell things like covered calls to try to recover faster. But if you're an older person who needs their money for retirement, you are way more time bound. There's a lot of things that come into it, and you need to consider that when you're dealing with the market. If you just want to make some additional money for some fun, well, you have to take a good, strong look at how much money can you generate, and do you want your money in your 20s? Do you want it in your 30s? What sort of plays are you trying to make? The main reason I bring this up is because I've encountered so many people who really just don't have many goals. The market is super exciting right now. Tons and tons of stuff is going on with it. There's ups and downs. Everyone knows about investing now. There are a million different fantastic phone apps out there that have low fees. Everyone wants to get into the market and mess around with the market. But I've continued to see a lot of people who are dealing with pretty substantial amounts of money that are just tossing it around and they don't really know what they're doing. So I would highly advise you to take a look at your performance in the market so far and consider if you can meet this metric. Can you average 10% returns? If you are, well, you could have just put all that money into the S&P 500. If not, if you're exceeding that, well, congratulations, you're beating the market, and that's pretty fantastic. If you're losing money, well, have you learned anything? Do you think you can come back to the market? Are you going to continue to lose money? Are you leaving the market? There is so much to consider when it comes to entering the market. There are ups and downs. There are time limits. You should have solid goals, and you should be achieving a certain type of return. I would say if you're receiving a 10% return or less annually, you should probably just stick to ETFs, unless you think you've learned and you can exceed that 10% margin. If exceeding that 10% margin is past your risk tolerance, you need to consider what strategies you're going to employ, whether you can deal with the risk of individual stocks or you prefer to use something like an ETF, which equalizes and hopefully minimizes these huge swings. There's a lot going on, and you always have to consider that. You always have to make goals, and this video is honestly more of a PSA than anything because I know there are so many people in the market, but there's also so many people that are completely lost. They're not thinking with their head. They're not thinking rationally. They're tossing money around and sometimes losing money. If you want to jump into the stock market and start investing, I have a referral link in the description for Webull. If you sign up, you'll get 2 free stocks and have access to a fantastic mobile and web app.